Welcome back to the Deep Dive. Today we're looking at, well, one of the most intellectually challenging scenarios I've seen in a while in the specialty pharma sector.
Yeah, we're talking about Assertio Holdings, ticker ASRT.
And if you're trying to make sense of ASRT right now, you're facing this monumental paradox.
That's the perfect word for it. On one hand, you have a company that just did a 1-for-15 mandatory reverse stock split. I mean, that's a move you usually see from companies that are in some kind of existential crisis.
But on the other hand, their latest operational results look surprisingly good.
Yeah.
Exponentially healthy, even.
Right. And that's our mission for this deep dive. How do we square these two things?
Exactly. You've got this genuine fivefold operational leverage, but at the same time, they had to pull a corporate maneuver of, last resort just to stay listed on the NASDAQ.
So we need to unpack these completely contradictory signals and figure out which one the market should really be listening to.
Is it a turnaround story that's just hidden by some bad optics? Or is this regulatory cleanup just, masking some deeper ongoing problems?
Let's get into it.
Okay, let's start with the hard facts. The big corporate action. Assertio Holdings did a mandatory 1-for-15 reverse stock split. It went into effect just before the market opened on December 26, 2025.
And this wasn't some strategic choice. This was absolutely forced on them.
Forced by the regulators.
The entire action was designed to fix one thing, a regulatory deficiency. The company's stock had been trading below the NASDAQ's $1 minimum bid price for a long time.
And by December 24th, the share price was all the way down to 66 cents.
Which was a 26% drop over the year. That kind of pressure is what created the need for this kind of drastic cosmetic surgery on the stock.
And this wasn't a surprise, right? The clock on this had been ticking for almost a full year.
Oh, yeah. They got the official deficiency notice from NASDAQ way back on January 22nd, 2025. That was after the stock had closed below $1 for 32 straight business days.
So they got the standard 180-day grace period, which ran out in July. And that forced their hand. They had to find a structural fix.
And that fix was the reverse split. But you have to understand the immediate kind of mechanical pain this causes, especially for smaller retail investors.
Okay, break that down. A 1-for-15 ratio.
It means for every 15 old shares you own, they get converted into one single new share. And if you have leftover shares that don't make a full new one.
So like if I held, say, 20 shares, what happens then?
Perfect example. You get one new share, and then the company just pays you cash for those leftover 5 shares. It's called cash in lieu.
And that's a forced sale, basically.
Exactly. And that creates a ton of short-term volatility and pain. Think about it. If you wanted to hold 100 shares, you now have 6 and a forced cash payout for the rest. It pushes people out of positions they wanted to keep.
And I imagine it's a huge headache for anyone holding options.
A massive one. The option symbol ASRT immediately changes to ASRT1. The whole standard 100-share contract thing goes out the window.
So what's the new contract?
It becomes this irregular deliverable. It's like 6 new shares plus a fixed cash payment for the fractional value. And that calculation, based on the December 24th price, is locked in. It doesn't change even if the stock goes to the moon later.
So all that complexity, the forced cash outs, it all just injects this huge amount of mechanical noise into the stock price right after the split.
That's it. For a little while, the stock is being driven by structural mechanics, not by the company's actual fundamentals.
Which brings us right to the core of the paradox.
Yeah, because historically, these reverse splits carried a huge stigma. It's basically an admission that you failed to maintain market value.
And the data shows stocks tend to drift down after a split.
And they do, because big institutional investors see it as a sign of weakness, even though the whole point is often to get the price up to a level where those same institutions are allowed to buy it.
But Assertio's Q3 2025 numbers they clash violently with that whole negative story.
They really do. Look at the top line. Total revenues hit $49.5 million. That's a huge jump from $29 million in the same quarter last year.
And they actually made money. A real profit.
A huge swing to profitability. They went from a loss of almost $3 million a year ago to a positive net income of $11.5 million in Q3. That is a real, tangible, operational turnaround.
The number that just pops off the page for me is the adjusted EBITDA.
Oh, absolutely.
It went up almost fivefold, from around $4.5 million to nearly $21 million. When you see that kind of leverage, you assume a company is firing on all cylinders, not scrambling to avoid getting delisted.
And the engine behind all that growth was one specialty drug, Rolvedon.
Okay, so Rolvedon sales soared over 157% to 38 million.
Just for the quarter.
Let's pause right there, because this success comes with a really crucial kind of time-bound asterisk next to it. We can't just look at that Q3 spike in a vacuum.
No, you can't. And this is the key piece of strategic data. Management was very, very transparent about this. That massive revenue surge was largely a one-time event.
It was a pull forward.
Exactly. It was driven by distributors buying up extra supply to make sure they had enough during some of Assertio's internal integration efforts.
So a fantastic quarter, but it was essentially revenue borrowed from the future.
Precisely. And you have to give management credit for being so clear about this. They've told you what's coming. That pull forward creates an air pocket.
An air pocket.
They've stated they expect, and this is a quote, no material net product sales of Rolvedon in Q4 of 2025 and Q1 of 2026.
Wow. So 2 quarters of almost nothing from their main growth driver.
Right. They don't expect the regular sales cadence to resume until the second quarter of 2026.
That clarity is interesting, though. Instead of trying to hide the drop-off, they're giving you a crystal clear 6-month window of low sales and then an expected restart date.
It gives an enormous piece of certainty to the market if you're willing to look past the short-term dip. And we also saw leadership changes to back this all up. Mark Reisenauer is the new CEO, Paul Schwichtenberg, promoted to president and COO.
So, new team, stunning Q3 numbers, and a focus on financial discipline.
It suggests they're taking charge and getting things in order.
Okay, so despite that, self-imposed revenue vacuum for 2 quarters, their updated guidance still seems pretty confident.
It does. They narrowed their net product sales outlook for 2025 to 110 to 112 million, and they actually raised their adjusted EBITDA projection.
And the balance sheet gives them a big cushion to ride out this lull.
A huge cushion. As of the end of September, they had $93 million in cash and equivalents. And critically, they hold more cash than they have debt. That gives them a ton of flexibility.
So with all that in mind, the valuation just seems off. The market is showing extreme skepticism. They're trading at a price-to-book ratio of just 0.66.
And for anyone less familiar with that metric, that means the market thinks the company is only worth 66 cents for every dollar of assets they have on their books.
Which suggests the market believes Assertio is just going to destroy capital or completely fail to execute.
Precisely. They're priced like a failing company, but they're sitting on a pile of cash.
And that disconnect is probably why you see analysts like at HC Wainwright sticking with a buy rating. They had a pre-split price target of $4.
Whoa, hang on. A $4 target before the split.
Yeah.
So if you apply the 1-for-15 ratio to that, you're talking about a post-split target somewhere around $60 a share.
Which sounds insane for a stock that was just trading at 66 cents. How do the analysts even begin to justify that?
It all comes back to the cash and the visibility. The analysts see the fivefold EBITDA growth, the big cash balance, and that fixed Q2 2026 restart date for Rolvedon. They conclude the current stock price is just irrational.
So it's being driven by regulatory fear, not underlying value.
And the reverse split, as ugly as it is just the necessary cost of admission to let the stock eventually reflect that value. The goal is simple. Get that closing price above $1 for 10 straight days and keep the listing.
And it's worth remembering what they're avoiding by doing this.
Absolutely. Getting delisted is a huge blow. They'd lose the ability to use a Form S-3 for easy public offerings, which makes raising capital a lot harder.
And they lose something called blue sky preemption. That sounds dense.
It's super technical, but really important. It basically means they would lose the easy ability to raise private capital across multiple states without having to go through a ton of burdensome local paperwork in every single state.
So it limits their investor pool and makes everything more expensive.
Dramatically. So the split, really, it buys them the right to stay financially flexible.
Okay, let's shift gears. We've laid out the tension here, the regulatory headache versus the operational health. So let's get into our this is not financial advice segment.
Absolutely not financial advice.
But if you were building a thesis here, what's the contrarian play that could capitalize on this massive discount?
The thesis is actually pretty simple. The market is irrationally obsessed with the stigma of the reverse split and the coming revenue hole from Rolvedon.
So the market is selling the noise.
And you buy the arithmetic.
I like that.
The idea would be to establish a long position, maybe with options, that targets the second quarter of 2026.
Why that specific date?
Because that's the moment of the guaranteed resumption of Rolvedon sales. Management basically handed you the date for the revenue rebound on a silver platter, which is incredibly rare in this industry.
But waiting 6 months for that rebound, and especially Forma, that's an eternity. What if they burn through that $93 million in cash faster than we think? This trade only works if they execute perfectly until Q2. That's a huge risk.
That is the risk, no doubt.
Yep.
But you're buying a degree of certainty. The revenue drop is predictable because it was planned. You're betting that the market has oversold the stock based on the split, and they're ignoring 3 key facts.
Okay, what are they?
1, the operational turnaround is real. Adjusted EBITDA is up 5-fold. 2, the valuation is genuinely cheap, trading at 0.66 times book. And 3, their market cap before the split was around $70 million, but they're holding $93 million in cash. You're essentially buying the company for less than its liquidation value.
So the outrageous but plausible idea is betting that once the dust from the split settles and that rolled-in engine restarts in Q2 2026, the stock price doesn't just hold the compliance level,
But it rapidly moves toward that equivalent post-split analyst target of $60. If that pre-split $4 target holds, you're capturing a massive return by exploiting the market's fixation on optics over the reality of the balance sheet.
It's a fascinating, highly contrarian position. It requires a long-term view that just intentionally ignores all the short-term volatility.
It's the ultimate test, really. Can you look past the regulatory noise and just focus on the numbers?
And as always, remember, this is not financial advice. Trading specialty pharma stocks, especially ones going through reverse splits, involves very significant risk. We are simply analyzing the strategies derived from the source material.
Absolutely.
So to wrap it up, Assertio Holdings, ASRT, is this classic, complex case study. They were forced into a painful, reputation-damaging reverse split just to stay listed.
Yet, their core profitability metrics, like that 5-fold jump in adjusted EBITDA, are signaling a massive operational victory.
It really is the textbook definition of corporate mechanics clashing violently with fundamental progress.
The whole situation forces you, the listener, to confront this dichotomy between structural necessity and financial health. Management created short-term pain for long-term clarity. The question is, are investors willing to look 6 months ahead and trust them?
Or will they just perpetually discount the stock because of the reputational damage from the split?
It's a great question.
So we'll leave you with this final thought to consider. Does the necessary use of a reverse split, that public admission of failure, permanently taint a stock's perception? Does it make it impossible for big institutional money to ever view the stock as clean, no matter how successful the actual operational turnaround proves to be? It's a true battle between public optics and private arithmetic.
A battle that has a very clear end date, Q2 2026.
Absolutely. Thanks for joining us for this deep dive into Assertio Holdings. We will catch you next time.